Welcome back to Investment 360. Joining us now is Eben Karsten, Portfolio Manager at Blue Ink Investments, coming to us live from our studios in Cape Town. Still with me is Suraj Sukju. Very good evening, Eben. Today we're talking hedge funds. It's quite an exciting space because I know that during the crisis, a lot of negativity surrounded the hedge fund industry. We were largely, of course, protected from some of the dismal performances that we saw globally, and our hedge fund industry didn't fall apart. And in fact, we're starting to see a much stronger scenario playing out in South Africa and very strong returns. Give us an indication of how we differ here in South Africa relative to the hedge funds on a global level.
Thanks, Eleni. I think just to mention there, I think if you look at the South African hedge fund industry compared to the offshore industry, the offshore industry is very much beta driven, and we saw that in 2008 where hedge funds offshore lost a lot of money along with the market. And if you look at the rebound in 2009 and 2010, we saw those hedge funds picking up quite a lot. In South Africa, the hedge funds are much more alpha driven, and what we see is very decent capital protection. So if you look at the down months in 2008 especially, hedge funds in South Africa did not do as badly as their counterparts offshore.
Is this similar scenario that is playing out at this point? Are we still alpha-driven relative to what we see on a global level? Or do you think that hedge funds in South Africa are starting to take slight more risk on their books?
No, I think if you look at year to date, for example, where we have seen some very volatile months where the all-share index at some points were down between 7 to 10% and then rebounding back at month end. What we have seen definitely from hedge funds in South Africa is that the guys have not taken on more risk. They stick to their mandate of capital protection. The hedge fund index, for example, which is an index that we run at Blue Ink, which compromises of all the different hedge fund strategies in South Africa, is up at the moment until end of August by about 5%. And that is compared to the all-share index, which was down at the end of August by about 2%. So the risks taken on is not higher at the moment.
Yeah, and just from my perspective and from a layman investor perspective, what would the reasons be for me to want to invest in a hedge fund? Is it purely to reduce risk? What are the main reasons that you would look at a hedge fund?
Well, the main reasons for a hedge fund investment is really the opportunity that a hedge fund can give you capital protection during down periods. Now, if you only protect capital during down periods, you won't have a decent return. So the important thing is that you should only, if you invest in a hedge fund, you should only catch, let's say, 25% of the downside and then about 40% of the upside. So I think the key thing is that it's the compounding of returns. It's also, if you look at the various asset classes out there, what's important within hedge funds is that we see them as a diversifier in any portfolio. And the correlation between hedge funds and between your standard asset classes is very low. So from a layman terms perspective, it's really diversifying your asset base and making sure that you have got some assets in there that can protect you during down periods in the market.
Well, let's look at some of the strategies you could be adopting. If you've actually gone market neutral, your year-to-date performance would be 8%, north of 8%, and that's quite a big number. So obviously you need to take a position on the market. So you're either long, you're short, of course, or you could be market neutral. You could be taking an aggressive stance. If you are within a blend of a hedge fund, does that mean that you could cover your bases across the board because you're that diversified with regards to positioning?
Yes, I think just the strategy that you mentioned there, which is market neutral. Market neutral is a strategy that actually tries to do what it says. So it tries to have an exposure to the market of zero. Now you might wonder, how do you then garner returns from that? You look at the guys that manage the portfolios are either long certain stocks, which they think are undervalued, then compared to the peers, and they are short stocks that are overvalued. So especially in times when we see high volatility, as we have seen this year, a lot of opportunities open up on a relative basis, and there's a lot of opportunities for market neutral funds then to make money within that scenario.
So even from a practical point of view, I would assume that you would run multiple strategies, and would that sit in different types of funds?
Yes, I mean, at Blue Ink, what we do, so we run different fund of funds. Now, so what we do is we blend various funds on a risk-adjusted basis to make sure that we get a portfolio that we believe is diversified to a certain extent and that we believe will have decent upside potential as well as then downside protection. So at the strategy level, we look at the funds on their own, and then what we do is we create a fund of that strategies, which would typically between, I'd say 5 to 8 managers within that space. And then what you can then do as well is you can then blend those different strategies together to give you an overall return, which would be very much the same as the composite index that I mentioned previously.
So Eben, just relating to the question that Suraj had asked you, then what is in it for the layperson? You spoke of capital protection. So then why aren't we seeing a massive inflow into the hedge fund industry? If you can get a return of 5% while the all share is down around 2%, is it because it is largely unregulated to this day in South Africa and globally? Yes, we know that the Financial Services Board is starting to create a different environment in the country. What is the reason that we haven't seen a bigger hedge fund industry in the country when you've got fantastic returns? Is it a risk issue? Is it a regulation issue?
Well, I think there's two things. The one is, and we talked about the offshore industry previously. The main thing in the headlines that normally hits the press about hedge funds is either spectacular returns, and we all think to guys like George Soros there, which made a lot of money, or you think of guys like Bernie Madoff, which lost a lot of money. So it's either very good news or it's very bad news. So I think the press on hedge funds that filter through to the layman in the streets is not always that good. What we see on the flip side is that if people really look at the risk numbers, and a lot of people think that hedge funds are risky investments. And I think the key thing is that hedge funds are not risky investments by themselves if you blend the strategies properly. If we look, for example, at the returns that is on the table that have been generated by hedge funds across the last 3 years, which has been a very volatile period, you can see that the hedge funds has outperformed the market and on all asset classes, be that bonds or equities, and with a lot lower volatility, and that volatility is less than a quarter of the volatility that you would get from investing into pure equities or bonds.
Yeah. Suraj, before we say goodbye, very quickly, your view on hedge funds. Do you buy into the story? Fantastic returns.
Yeah, no, look, I think it has its space, but I think it's also an investor, investors need to increase their knowledge on what hedge funds offer. It's not to shoot the lights out. I think it's for protection. It's to reduce volatility, to reduce risk, and it's to provide an absolute return, and where you want a diversified portfolio, hedge funds does have its space.